Hello. Okay, good morning, everybody. Welcome to our 11:15 webinar. So thanks for tuning in. Today, what we have for you is we have Sam, who's going to talk to us about Greece, followed by a macro update, following which I'll give a quick technical analysis of the S&P 500. And following that, we just want to prepare you guys by going through a simple TA concept that looks for, which is a common reversal signal, which hopefully you can use to give you advance warning as to where the major markets are going. Okay, so without further ado, I'm going to pass the mic to Sam.
All right. Thanks, Ken. Morning, everybody. So the theme of this week is uncertainty, and the story won't be complete if we talk about Greece because that's the main reason for this rise in uncertainty. Uh, so this is a slide that we had a couple of weeks ago, and for on our side, the analysis that we had has not changed yet. We still believe that Brexit scenario is something that both the parties wants to avoid. It's just that the probability of Brexit has increased substantially now. So it looks after yesterday's referendum where the Greek voted no, uh, that means against the austerity plans. Now it seems more probable that they might have to see an exit to the Eurozone. What happens to Greece still remains the same. They'll be cut off from further funding. They will have hard time. Might have to start um, their drachma currency parallel to euro in the first phase, and that will see a huge depreciation in of uh, their own local currency against euro. Uh, they will be holding a lot of bad debts, and so probably we'll have to negotiate with the parties in future in kind of refinancing it. Okay, Greece will be in bad situation. How about the Europe? Uh, we still believe that Europe will survive. It will be a very small, short-term only volatility play only. Greece is a very small economy. I mean, if you compare it with U.S., then Greece is something like the size of Alabama. And if Greece default, uh, nothing much. I mean, the Spain will continue to recover. Germany is thriving right now in terms of recovery. It will continue to do so, and economies like Italy and France will continue to improve. There's not much of a problem from the Greece side. It's something you can try to understand it in a way that in U.S. when Detroit got bankrupt, the city got bankrupt. Nothing much happened to the nation's economy, and so we believe that if something happens to Greece, nothing really much will happen to the entire eurozone. Uh, but the most important point here is that you should expect short-term volatility until this thing is settled down. The Greece still needs to pay $3.65 billion to ECB this month. I think it's 20th of July. So if they don't do so, they will be going default. They have already done it with IMF. They'll go default to ECB as well. And I think this volatility might accelerate a bit. Okay, moving on. So our theme would be to stay defensive. Volatility remains high, and I'll show you this in a second. Investors are exiting. Right now, the trend is that investors are exiting U.S. equities. So a lot of, I mean, if you see the table on the right-hand side, you would see that domestic has been all negative, and this is for domestic here means U.S. World has been positive, but the world here, if you look into the emerging market, mostly has been negative that means outflow as well. And so most of the funds are flowing into the Japan and a little on the Europe side. Japan fund, if you are a regular attendee of this webinar, then I think a few weeks ago I had a very thorough analysis on Japan and the funds flowing into Japan, and why not the economy is not so much important, it's the fund flowing into Japan which is more important. I had a very thorough analysis on that, and so this table kind of like just justifies and backs my analysis. So given these uncertainties, we should reduce beta, that is lower our risk exposure, go with a value and defensive play in the event things turn okay, and so stick with the value defensive markets and names such as REITs or the healthcare sector. Okay, so here's the volatility. VIX equals to fear, so that's the index that is for volatility, and you would see a sharp jump recently. This is equivalent to saying that markets are afraid, no doubt about that, and it may point to downside. At best, it means it will be more difficult to make money. Okay, in the second chart, the Mad Max 2011, is how much down the market is from its last high. It's based off of the beginning of 2011. This is monthly data, so it's not as clear what the real maximum drawdown was, but even with daily data, there have been only two 10% corrections since 2011. One late 2014, I think around September period, and one in 2012. As you can see here, by the end of the month, none had been down more than 8%. We have been in a new grade moderation. Basically, for the past 3 years, we have had only lost a maximum of 4% before your portfolio started to grow again. And since the end of 2011 correction, you would have made nearly double your money. So market is overdue a correction. Will it come? It's really hard to say at this point in time. But if it does, then there will be plenty of people who would say that we saw it coming. And as we saw in the previous slide, people are pulling their money out of equities in the US market and in the emerging market already. So this is something, like to watch out for. Okay. So should be worried about the current situation, let's say in Greece, the Greece default and Grexit and stuff. Well, Greek debts won't hit U.S. banks very hard. I think the U.S. in total, the U.S. bank holds around 10 billion out of 250 billion of Greece debt. So it's not a big amount. Even in the European, let's say the German banks, they hold around 11 billion dollars of the entire 250 billion dollar Greece debt. So these banks might not be hit, to an extent what you would hear in the news. China has very large amount of bad debt successfully before, and it will probably be able to do it again. They have already started to have this debt swap going on with the municipality loans. This is to overcome the shadow banking, and so this is something of a good reform that we are seeing from the Chinese side. U.S. job creation data suggests demand is there, and so this much talk about the interest rate hike stuff will be mostly demand driven and not the inflation driven, so it's a good thing. And like we mentioned last week as well, that the last time they did it in 2004, the market rallied until 2007 when it crashed. So moving on. So here, okay, so what we are saying is to be defensive, and in terms of tech sectors, we can see clear trends in money flows. If we, let's say, the according to the Wall Street Journal, biggest weekly outflow has been from the financial sector. Block trading activity shows institutions, which are the smart money, uh, are buying utilities and technology and selling telecoms, materials, and energy. So in short, buy defensive, sell cyclical, and our picks for defensive would be REITs. A few of them like SolBuild, First REIT, FCT is what we have buy calls for now. And quality names such as 800 Super, which is a waste management company, and then the Cogent, which is has exposure on logistic warehousing. Uh, I got no comment on this slide. This is just to show to those who are watching, to give a glimpse of what's happening on the commodity side as well. So oil flat, corn really picking up, gold flat or maybe a little down, and then the corn we have seen a little bounce in recent weeks and or months. With this, I'm gonna pass it to Ken. Thanks.
Okay, hey, thanks, Sam. All right, just a quick one. All right, so we've been talking a little bit about Greece and potential downside of Greece. Talked about some uncertainty. So let's take a look at the actual S&P chart itself. Okay, it's been some time since I put a chart like this on screen, but let me just tell you what I see over here. Okay, so the top chart here is S&P weekly. So as you can see, um, based on just the last 5 years, right, we see that actually we're still in a consolidation pattern over here. Okay, it's consolidating. But what is underlying this move? How much strength is underlying this, or is it weak? Well, it's kind of mixed. Right now, the underlying strength of this trend is mixed to slightly weak. Here, what do I mean by that? Okay, essentially, right, you do have some divergences in breadth. Okay, we see that the number of stocks here, number of stocks below the 50-day average, right, has been decreasing. Okay, this shows you that there is weakness in this consolidation here. So what that means is usually when there's a consolidation like this, it can either break upwards or break downwards. Okay, either or. This is telling me that it's most likely going to break downwards. Okay, but this doesn't tell you how much lower it will break. It just tells you that there is weakness in this consolidation. Most likely it's going to drop a bit more. Okay, so you have this divergences at the MACD and this as well. However, right, at this point in time, it's way too early to say that we are entering a bear market. I think that's some time away, quite frankly. Okay, the rationale is that there are still other indices like the Home Builders Index that is not obviously weak. It's actually relatively robust looking. So in a Dow theory type of mode, it's not confirmed yet by other indices. Okay, so that leads me to say that the overall trend is still up until proven wrongly. Okay, but that doesn't mean that it can't be no short-term pullback. Okay, so this divergence over here tells me that the chance of a short-term pullback is higher than upwards. Okay, um, we also note that at the same time, right, the Russell to S&P ratio, right, well, it actually has been improving here. That's why I say it's a bit mixed. Okay, so can there be a pullback? Yes, but this tells me that a bear market is probably not going to start yet. When I mean by bear market, I mean like multi-year bear market. Okay, now as Sam has said, the VIX has started to go up here, but this is what I think might happen. So depending on how severe Greece pans out, okay, which as Sam has mentioned that in terms of global financials, it seems to be quite contained. So I would like to say that most likely there'll be a short-term pullback, and it'll most likely probably bounce off this 70-week average, this blue line over here. As you can see, the 70-week average is a very strong support. It has bounced off many, many times. It only breaks when there is basically quite severe news. That's when it breaks. So I'm going to say that based on the weakness of the divergences, okay, that this will probably drop towards this blue line before bouncing off. Now, if it breaks further down, then we might have a reversal pattern, which might lead to a bigger correction, and we'll talk about that later on. So basically, a bullish trend is expected unless the price drops convincingly through the 70-week moving average major support. I expect the price to actually hit the blue line, by the way, on the short term. Okay, so keep your eye on this blue line, because if this gets broken, okay, a particular reversal pattern might form that might cause more than 10% higher than 10% correction. Okay, so what are we talking about? So what I like to do now is to value add to our clients and all. We're gonna actually do a small educational piece. Okay, but before we do that, just wanna give a shout out. Don't miss our weekly technical report on Singapore equities. It's out basically every Tuesday or Wednesday depending. Okay, and it looks something like this. Yeah, so in this we usually highlight 3 or 4 counters and what's interesting about them and whether they look bearish or bullish. Okay, so here's just an example of last week's report. Okay, here you can see the example that we said that after Yuzu broke out this trend line here, which you highlighted, is now in consolidation here. Yeah, this is just an example. Okay, so please check out this recent report and also check out the ones every week. Okay, okay, let's continue. Okay, so now that we are in a season of what could be uncertainty, right? So let's talk about some things that's worth looking at. So this might be basic to some, but if you haven't heard of this, I think it's important. So let's look at some reversal patterns in TA. Okay, I mean, since we're in uncertainty, right? We like to look out for potential reversal patterns. Okay, so here are the contents. We're just going to go through a quick intro. We're going to talk primarily today on the head and shoulders reversal pattern, just one example. And I'll tell you where you can find more examples, okay? When you do see head and shoulders pattern, how do you find the price objective? Okay, then we're going to talk about what's an inverse head and shoulders, talk about some statistics, and finally we're going to summarize this, okay? So let me just say, okay, so Thomas Bulkowski, author of Encyclopedia of Chart Patterns, he said, investing using chart formations or chart patterns is an exercise in probability. If you play the numbers long enough, you will win out. And later you see what we mean. Okay, so today I'm only going to go through one example for you, just the head and shoulders and inverse head and shoulders. If you want to see the statistics and how to identify and trade the other patterns, can I just refer you to these 2 books, especially the first one, Encyclopedia of Chart Patterns by Thomas Bulkowski, he was an ex-engineer that I guess you can say that his work over here is what might be considered quantitative finance, because he basically tried to look at a multitude of stocks, over about a 10-year period, and he tried to track every time he saw a particular pattern and what happened when the pattern occurred and what happened if the pattern broke, and he had statistics on all of them. So this might be worth your while. Please take a look at this book here, if you're interested to know more. Okay, so it's just a quick introduction, okay? For TA, these are, I guess you can say it's the basics. There are 2 major categories of price patterns. It's either a reversal pattern or a continuation. So either it's an uptrend that's going to go higher or it's going to reverse, right? These are the 2. Here are some common reversal patterns: head and shoulders, triple tops, double tops, spike, V tops or V bottoms, and saucers. There are probably a few more, but these are just the common ones. And of course, common continuation patterns are like triangles, flags and pennants, wedges, and rectangles. Okay, if you want to know more about these, you can check out this book here, Technical Analysis of Financial Markets by John Murphy. Okay, so today we're going to talk about, but before we talk about a head and shoulders pattern, just know that there are some very common characteristics of all major reversal patterns. Okay, so the first characteristic is the prerequisite for any reversal pattern is the existence of a prior trend. So if it's going to reverse on the downside, it has to have a clear upside. The first signal of an impending trend reversal is often the breaking of an important support or trend line. Sorry, typo here. Breaking of an important support or trend line. Okay, the larger the pattern, the greater the subsequent move. Topping patterns are usually shorter in their duration and more volatile than the bottoms. Bottoms usually have small price ranges and take longer to build. Okay, and finally, volume is usually more important on the upside. That means when you're reversing on the upside, right, the first move spikes up on volume. That's usually more important in terms of how much more it can continue. On the downside, right, if your price breaks down, it can actually drift lower, quite low on low volume. So volume is more important on the upside. So this is common to all reversal patterns. With this in mind, let's talk about the head and shoulders. So, so here you can see this is just a chart of the WTIC, crude oil chart from basically mid 2010 to towards the end of 2011. And it's been on a long uptrend, as you can see here, right? And finally it tops out at 114 and goes on a really big decline, drops almost by 40% like that. Okay, but you notice that there's actually a pattern that forms. Okay, now head and shoulders, what does that mean? It means you have, if you can draw a neckline like this, on the uptrend you have a left shoulder, which is this, a head, which is like that, and a right shoulder. So all of a sudden you have, here you have higher highs, but all of a sudden now you have lower highs. When you have lower highs, right, that's considered the right shoulder here. This is what you call the neckline. The neckline meaning that's the line where your shoulders and the head is like kind of bottomed out at. Now the key thing about the head and shoulders is this: when the price actually forms the shoulders and breaks below the neckline, we say that's the breakdown. That breaks down, okay? Now usually, okay, price actually comes back up again towards the neckline before completing its rundown. This move back towards the neckline is called a throwback. Okay, so this is a typical classic head and shoulders top reversing pattern. Okay, so anytime you see a higher high, that's good. But all of a sudden when you see a lower high, okay, then you got to be aware that this thing could actually break lower. Of course, it is possible to have a failed head and shoulders, meaning it drops here and then it just goes back up again. All right, it's possible. But most of the times when it breaks like that, right, chances are it's going to continue downwards for a bit more. Okay, so let's continue. Now, we actually can find a price objective based on the height of the pattern. Okay, what does that mean? Okay, let's show you again. Now, okay, so we know this. Okay, we know that the price is going to break below the neckline here, right? Break below here. But then when it breaks below here, what is the probability that it's going to hit a certain price? We call that the price objective. And this is how you measure it. When it breaks down the neckline, take the initial height of the head. In this case, okay, whoops, what's the neckline here? In this case here is roughly $17 of height here. Now, when you finally break down, project this $17 downwards like that. And there's a good chance, more than 50% chance actually, that price will end up somewhere at this level or more. So this is what this is a price objective, and this is the minimum price objective. Now, barring the lack of other technical signals or support levels. So if you don't have any obvious support levels or other technical signals, on a major reversal breakdown, this is your minimum price objective as follows. Okay. We can do this on the upside as well. So here we have an inverse head and shoulders, meaning it's the same as the head and shoulders, but it's opposite. It's a bullish pattern now. So in this case here, now TA is a little bit of art. So we can actually draw a neckline this way, like so. So here you would have your left shoulder, your head, and then your right shoulder. Same rules apply. This was the downtrend over here. Then you had lower lows, and all of a sudden from the lower lows, now you have higher lows, right? So this one becomes kind of like the right shoulder. So here's, you can put your initial height here and look at the projection. As you can see, price did actually reach over here before it immediately reversed downwards. So probably a lot of technical traders were trading this pattern over here. I also like to point out that these sort of technical patterns, right, are much more useful to use when the fundamentals of the stock or the economy is uncertain. The more uncertain it is, the more TA becomes useful. Because when it's uncertainty in the fundamentals, no one really knows how much that thing is worth. Everything's speculation. When things are speculation, that's when TA becomes the most useful. Okay, so another way of drawing this head and shoulders is inverse head and shoulders is like that. Okay, instead of this one over here, you could actually have done this. It's, so it's basically almost the same thing. As I said, this is an art. Okay, it's not a science, but essentially you see the same characteristics, right? This is actually a major support, a major resistance over here actually, and so the breaking of the major resistance marks the reversal pattern, just as this is a major trend line as well, and it breaks here. So in this case, you broke through two of them, right? So it's kind of like double the strength. Okay, so that's how you get the price objective. So how often do you get this? How often can you actually get this objective, right? Because surely not all stocks that break out of this sort of pattern, right, will reach its objective. And you're right, not all the stocks will reach there. Okay. But before we talk about the stats, right, let's just go through a quick exercise in reversal patterns. Here's another stock. It's a 3-year stock chart from 2008 all the way to 2011. And you can see reversal patterns. So for example, here's one Head and Shoulders right here, right? And you'll notice that on the breakdown, you almost got to the price objective here on the breakdown, okay? Then similarly, on the way up, you can draw this trend line here. Here's a warning that this downtrend has been broken. It's a warning, okay? And then the confirmation would be this basically double bottom type of thing. Here's the first target over here. See, when this thing breaks here, right, you can project the target, which is here. And as you can see, the price actually stalls at this target. And then the second target is here. The next break, like so, is kind of like that as well. Second target, minimum, right? And finally, like on the downside here, you have something like a consolidation, complex double bottom. Here's your major support, and once you broke down from it, you got your minimum objective as well. So here's an example of how these patterns can be used to confirm the downside or the upside. Let's talk about statistics now. Okay, so we talked about the inverse Head and Shoulders and the Head and Shoulders. Okay, so just like to point out these two things now that we're talking about statistics. So Bukowski does say investing using chart formations is an exercise in probability. If you play the numbers long enough, you will win out. Vince Scully says that statistics are used much like a drunk uses a lamppost for support, not illumination. So I mean that means that you can do better than just looking at chart patterns. You know, if you suspect that there's a Head and Shoulders which might lead to a major reversal on the downside, it'd be good to use other methodologies like fundamentals or even quantitative stats to determine whether it's even possible for a major reversal. Similarly, on the downside, if you think a stock or the market is bottoming, right, there really should be fundamentals to support it. So please use these patterns, right, with some other technique. These patterns are there to guide you and to add to your probability of winning, but it in itself might not be just enough, okay? Okay, let's talk about the inverse Head and Shoulders, okay, which is the bullish reversal pattern. That means the price has gone down, then you have the inverse Head and Shoulders, and then the price breaks up. So here are some key characteristics I just want to point out. There are actually a lot more. And to get the rest of them, please go take a look at this book by Thomas Bukowski. Okay, it's not John Murphy, it's Thomas Bukowski. 1. Throwback happens half the time. Interesting. Okay. And it is a robust signal. So every time you see an inverse Head and Shoulders, you should get interested. You should get interested to do further investigation. And finally, U-shaped volume patterns tend to have better performance. U-shaped volume patterns means there is high volume on the left shoulder, high volume on the right shoulder before the breakdown or the breakup. Okay. So here are some stats for you, which I thought was interesting. Let's ignore the average rise, okay, for now. But basically, you see that in a bull market and a bear market, here are the stats. Throwbacks happen basically 50% of the time. Okay, so just because you have a Head and Shoulder break, like that, okay, break, right? The chance of basically coming back to the neckline here is actually 50%. So don't be surprised if when it breaks down, you take a trade and it starts pulling back like that. You know, it happens. Okay, and at the neckline, if it does get back chance to get back to the neckline, this is actually a great place to put a trade down. Okay, let's go back. Now here's an interesting point. In a bull market, right, the percentage of meeting your price objective is actually 74%. It's very, very high. That's why we say it's a robust signal. If you have a successful inverse Head and Shoulder breakout in a bull market, the chance you hit your price objective is very high. It's 3:4 basically. In a bear market, when you see the breakout, the percentage chance of meeting the price objective is 50%. But the point is both of them still have a good positive expectation. That means the chance of making money is higher than losing money when you see this pattern. So definitely you should pique your interest when you see an inverse Head and Shoulders. What about the Head and Shoulders, which is the bearish reversal, meaning prices are getting toppy. Then you have your left shoulder, right shoulder, head, right shoulder, and it breaks down. The The stats are similar but a bit different. Throwbacks happen also more than 50% of the time, 50% or more. But what's interesting that in a bear market, right, the pullback is actually higher than 50%. So don't be surprised in a bear market if there is a pullback, right? I think it's because that fundamentally markets are more bullish than bearish. So the first time a major breakdown occurs, there's probably a lot of unbelief that the bear market has started, and there's also a lot of buying interest. That might account for the fact that there are more throwbacks in the bear market. It's also a robust signal, just not as good as the inverse head and shoulders. Tall or narrow patterns, tall and narrow, perform better than short or wide. Okay, patterns with a rising volume trend, U-shaped trend, or heavy breakout outperform those that are not. So here are the stats. In a bull market, throwbacks is 50%. In a bear market, it's actually higher, and the percentage of meeting your price target, okay, is about the same, 50%. So if you do see a head and shoulders pattern, it means it's likely the price is likely going to come down, then it goes up, basically, and it should pique your interest on the short side. So this just outlines what sort of tactics you can use to trade a head and shoulders pattern. So before a head and shoulders occur, you've got this downtrend. This is the inverse head and shoulders. So you've got a downtrend, and then one day you're going to realize that here's the lower low, lower low, lower low. One day the low is going to be a higher low. So once it's a higher low, that means there's a chance that this could end up to be a inverse head and shoulders pattern as follows. Okay, so then you have a choice of how to trade this thing. The most aggressive, very aggressive trade is to buy just after the head. But the thing is, to be able to do this, right, you have to use other methods to preempt whether this is a head or not. You have to have other reasons. Either you do fundamentals, you do quant, you have other reasons to buy it at this level. So this is the most aggressive level. This is the home run, because of course, if you buy it here, you take the maximum gain. So as you go further, that's the more conservative play. So another place you can actually buy would be at the left shoulder, okay? Meaning that you assume that the level of the left shoulder here is about the same as the right shoulder. As you get somewhere there and it turns around, the moment it turns, you think it's the right shoulder and you can buy it here, okay, here or here. Some people also buy on the breakout, so they wait until the pattern is broken out and they buy at the breakout. And the most conservative is that it breaks out and people actually wait for a throwback and they buy here. So this would be, I guess, buying at the throw right here is your very conservative classic reverse inverse head and shoulders trade right here. So here's aggressive, here's conservative. Okay, your gain is going to be less obviously when you buy it here, but you have more verification that this is occurring the more you wait. Okay, so how aggressive you want to be depends on how much conviction you have on this stock or market, depending on other reasons. To highlight an example of the head and shoulder pattern recently is that if you looked at our weekly technical report in 19th of May, okay, I highlighted that this was a bullish highlight on Yuzu. I said this is what it is today on the 19th of May, and I said that look at these reasons here. So this is a little bit home run because I didn't wait for a head and shoulders pattern. I said there's a bullish break of the intermediate trend line here because the price just broke out of it. The bullish candle had strong volume. This candle here had strong volume. And remember we talked about how in an inverse reversal pattern, volume is more important. And here was obviously a case of big volume. Finally, the MACD actually crossed. So this is actually momentum. We didn't talk about momentum, but we'll probably talk about it next week. So tune in next week to talk about momentum. So these are the three things that tell me this could be a start of something. So a few weeks later, this is where we took the trade right here. A few weeks later, we made it up here. So it basically went up by, let's see, here's 23 cents, here's 35 cents. It went up by like, what, 50%, something like that? Or 40% up here. But here's one thing to note. If you look carefully, you'll see that the price had come down. It consolidated here and had a small consolidation here, here and here. You can actually say that this is sort of like a left shoulder, head, right shoulder. And when it broke out to get to this point, can you see that this is actually a price target? If you take this level over here and project it like that, it's roughly the same thing. So if you're not sure about the valuation of Yuzu, then this would be a good place to take profit. And that's in fact what we suggested. When the price hit 35, we suggested investors take profit unless they were very convicted on the fundamentals of the company. Okay, so here's a more recent example. Okay, since we're talking about the uncertainty of the S&P, I'd just like to point out before a real reversal occurs that leads to a bear market, let's see what happened in the last cycle. So here's a 5-year chart from middle of 2005 to 2010. Of course, here's the fateful bear market start or the bull market top over here. And you'll notice something right here. You'll notice that this is somewhat of a complex head and shoulder pattern. See, as usual, you have higher highs, and all of a sudden your higher highs became lower high. That's your first hint. And this became a very big support zone. As you can see, there's been consolidation here, 1 here, 2 here, and 3 here. So this is a very strong, we say it's a strong support. So we had the breakage of the support and then a throwback, and the throwback could not break out of this. So when this happens over here and it comes down here, this is an indication that there's a good chance that this is a real topping pattern, and you can do a projection based on that. Okay, and that led to the major reversal. Subsequently, on the other side, right, we had 2 years of a bear trend, and and then we had the bull market like that. But if you see on the bull market side, same thing. This is an inverse head and shoulders here. The left shoulder, the head, and the right shoulder. And that was the major reversal pattern that triggered the bullishness that we have until today. Okay. So I think it'd be a good idea that now that all of us are thinking about how overextended the S&P is, etc., we should look out for such reversal patterns. As yet, right, we don't have a confirmed reversal pattern yet, but we do see a bit of weakness. Okay, so just let's keep a lookout for major support lines and major patterns that are being formed. So here's a summary again for your reading benefit. 1 to 6, we talked about it just now. Remember that in an inverse head and shoulders, in a bull market, successful upside breakout has a 74% chance of hitting the price target. In a bear market, it's only 50%. Okay, for the head and shoulders, in a bull market, the successful downside breakdown has a 56% chance of hitting the price target. In the bear market, it's 55%. It's roughly the same. But in a bear market, the throwbacks happen actually more than 50% of the time, and we shouldn't be surprised. Okay, yeah, high volume breakouts increase performance. Remember that technical patterns are a guide, and they should be combined with other forms of analysis in order to increase the probability of a successful trade. Other forms can be fundamental analysis, quant analysis, or sentiment analysis. Okay, so I think that concludes today's webinar. So we'll open the floor for some questions. Okay, so the first question is, the blue line corresponds to the 2003 level? Question mark. Yeah, let's look at that again. And yeah, basically it's around there. I guess you can round it to 2000. Yeah. So the blue line is, in this case here, is 2003. By the time this price hits the blue line, it'll probably be slightly higher, maybe 2010, kind of.
Morning, this is Richard speaking. There's a question on 800 Super. The question is, 800 Super has been weak for a while, good to buy, to average. First thing first, I'll point out that 800 Super will be announcing their full year results probably sometime in the late part of August. So their financial year ends in June. What you would see is that if you look through the company announcements, they actually had announced a contract sometime in February that's worth 38.6 million, and for 3 years the contract was awarded by the Ministry of Home Affairs. And if you take an average of this 38.6 million over 3 years, that should be looking at some revenue recognition of about 12.9 1.9 million per year. That's on average. And if you put that in context for their FY14 revenue full year, that was 115 million. So that this contract is worth about 11% of a full year revenue. So actually, the good things about this company, if you look at their results over the years, they have managed to maintain their margins. The net margin is about 7. It's high single digit there, and ROE is about low 20s to high teens, about 20. And so you get good ROE from this company. And in this time of uncertainty, you can see that the waste management business is resilient and is one of the defensive stocks at the moment.
Uh, Hi, there's a question: with Greece going to Brexit, the risk that the other troubled countries like Spain, Italy, and Portugal may follow the same as Greece, which make the whole EU even more messy. Is that still a risk? Uh, it's really hard. It would be very unfair to compare Spain, Portugal, or Italy with Greece. The reason behind that is because Spain is on a very firm trend on towards recovery. Even the Portuguese and the Italians as well. If you look into the Greece side, they have been under the water for so many years. Like for 5 years, they have been the EU have been bailing out them, and nothing has worked out for them. They have been under recession for so long. You compare with Spain. In Spain, there was a bailout, but that bailout was never for the government. It was for the those big banks within Spain. So it wasn't that the government wasn't able to fund their own um, spendings, but it was more of to save those banks. In the case of Greece, the government did not have the money; they could not do anything, and so they had to be bailed out by the European Union or in the IMF. So it will be very unfair to like compare both these two countries. Uh, I cannot think of the. There's a lot of talk about the contagious effect, the contagious, but for me, contagion is just a word, and it's not something that is uh, might be of very much relevance in the near future. In the near future, and why I'm saying near future is because in December, Spain have their election, and one of the party called the Podemos, which is equivalent to Syriza, the anti-austerity party, is according to many surveys is the leading party right now. That might have some something to watch out for, but other than that, even Italy and even yeah, Por Portugal, they are able to fund their own spending, and that is the most important thing. They are not under recession, another important thing, and so I don't think that there will be a contagion effect, for at least for now. Doesn't seem to be the case. There's this question: what will be your take for Malaysia economy and their currency? Unfortunately, the analyst who covers Malaysia, uh, she's on leave. So once she's back, probably you can ask this question to her. There's another question: how will all the things happening in Greece affect Singapore? Well, anything that happens in Singapore brings on volatility, and the volatility is not only on the Europe side, it goes along with the entire global. If you look into the U.S. futures right now, they are down more than 1%. Most of the market, including Nikkei or the Australian market, are down as well. And so the effect on Singapore will be the same. Um, but like I mentioned, it will be a short-term volatility play until this thing is settled down, and this thing has to be settled down. Either they get out of the eurozone or they do not, and this thing has to be settled down by hopefully by the end of this month. So during that time period, market will be volatile, and so will the Singapore market be as well. Another question: are we saying that if Brexit does occur, that the all 250 billion of USD debt will be written down? Which banks will be most affected by this? Okay, to answer, when the Brexit happens and Greece has already gone default to IMF, they might probably go default to European Union as well. When a country goes default, it does not mean that they are gonna not pay the principal. It's just that they were unable to meet the interest payment. Now they hold $250 billion of debt, and it does not mean that they are not gonna pay anything out of it, because then they will have to face sanctions, because these countries, especially Germany, France, Italy, and Spain, which owe the most of it. I mean, the eurozone itself owes around 80% of it, more than 80% of it, will not leave it and let go such a big amount of money. In terms of banks, fortunately, banks do not owe a lot of it. Like I mentioned, U.S. Bank only owes $10 billion of this debt. Even the European banks, they owe only like $11 billion out of the entire debt. So the impact to these banks, which are big in number, and their profits are more than their quarterly profit might be more than this amount, so they won't be affected uh, much by this thing. And it does not definitely mean that Greece will not pay back the money. They will definitely will have to pay back. There's no doubt about it. They might have to refinance. They might have to stop for let's say 5 years time period, and only then start to something like what is going on in Puerto Rico, or what happened previously in Argentina when they went bankrupt or default. They had to renegotiate their financing terms, probably reduce the interest rate, and then defer the payments for next 5 years or so, so that they will be able to make the payments. After 30% correction, your view of China going forward? Again, China, Malaysia, and most of these ASEAN countries, the analysts who cover is on leave, so I think that person will be a better to answer these questions.
Okay, thank you. This will conclude our webinar for today. So we look forward to seeing you next week. Thank you very much.